So we went into today's action. I tweeted out, don't be surprised and don't go crazy when you get a 1 to 2% rally, because that's the kind of moves you get when you are below moving averages, as much as we ended Thursday. And lo and behold, we get about a 1.25% rally to the upside on the S&P on Friday. Incidentally, the CNBC at the close was saying, "Hey, we finally got a bullish update," and it's like we got the exact same result a week prior with the exact same opening gap. So it's in terms of recency bias, they seem to have forgotten that we had the almost the exact same move already, relatively recently. So that's what we do. You get bearish moves followed by big bullish moves, and then you extend back to the bearish side. And Friday today we seem to be in the mode of bouncing back up, and we'll see what the charts show us in terms of what we should expect to see going into next week. Whether we'll get a new leg to the downside, or we'll continue to break back up, and what we expect to see. So that's what I'm going to break down in today's video, and we're going to take a look at a stock that's had its own little breakdown into an area with a lot of volume, into an area between some support and resistance levels. So we'll talk about probably a pretty predictable for you way to trade it. So let's go ahead and get started. Today is Friday, October the 1st, 2021. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off with the market forecast on the S&P 500. You can see the rally that we had on Friday pretty much produced a Harami pattern here, which is you get a pretty relatively big body with the opposite, a bearish in this case, with a bullish body completely inside of the bearish body. Though it was a lower high and a lower low, the bodies stayed kind of like a reverse engulfing pattern, so to speak. Of course, in momentum and near-term line rally, but I mean, shoot, the momentum line got to neutral territory, midpoint of the chart. The near-term line still in bearish territory, so it's hardly like significant bullish rally here. Long-term market sentiment is still in bullish territory, so the intermediate posture is bearish. Obviously, it's almost down below 20. If you look at the Dow Jones Industrial Average, it just barely got below 40, and you can see short-term sentiment bouncing up, very similar to what you saw. Again, very similar type Harami pattern here. If you take a look at the NASDAQ 100, you can see its intermediate line actually fell below 20, so in the low reversal zone, but short-term sentiment looks almost exactly the same. A little bit of a long lower shadow again. See, we had broken down below that support level. In this case, a long lower shadow is at that 23% retracement level of this big move off the Halloween low point. Remember, the NASDAQ actually did form an intermediate pullback in May, so that's what the red lines are based off of, but the black line is based off the same low off the same low on the S&P 500 from Halloween of last year, which is the S&P's last intermediate low point. Of course, the NASDAQ has had two intermediate low points since that one, since the last one the S&P has had. Interestingly enough, because the NASDAQ is a big factor, NASDAQ 100 is a big weighting within the S&P 500, yet it's had two intermediate pullbacks and the S&P hasn't. But short-term sentiment looks almost exactly the same. The Russell 2000's intermediate line is actually still in bullish territory, so it kind of shows a little difference there. And the Russell 2000 closed above the prior two highs on Wednesday and Thursday. Barely, but it closed above. So you can see a lot more bullish from that perspective because it wasn't nearly as bearish. But the short-term sentiment, is pretty much almost exactly the same. So, of course, the near-term line last time the near-term line made a bullish rally, it wasn't able to get above 90. It got above 80 on both these levels. And as a result, we never really got going, right? We didn't change the trend. And so now the question is, where is this next near-term rally going to peak, right? Where is it going to peak up? In fact, first of all, is it even going to get out of bearish territory on Monday? And if it does, where is it going to peak? And that's the important consideration as to whether or not we change this trend or not. Let's take a quick look at the weekly chart since we finished a week here. on SPX. You can see the intermediate line has just barely come down below 90, so it's still easily in the upper reversal zone. So is long-term market sentiment. Near-term line still coming out from extreme lows, so hardly, it's like we're hardly like dropping like a rock here. That's the Nasdaq. The S&P. This is the Nasdaq. Looks very similar. The Dow Jones Industrial Average also looks very similar. It actually did get a light green shading here, so we did close slightly below the 30-week exponential moving average, whereas the Nasdaq, you can see, did not. Remember, the Russell's been a lot more bearish, so we've, the intermediate line, or the 30-week moving average, a lot higher, and you can see on the weekly chart here, very similar to the daily chart, whereas the intermediate line is kind of flirting with the low end of bullish territory, in this case sitting right at that 30-week moving average, and really for the last so many weeks not really moving above or below it by a significant degree, as we've just come down to kind of neutral territory, a higher end neutral territory, but neutral territory, and haven't really moved anywhere. Let's take a look at the other weekly charts that we always take a look at. SPX, you can see the PPO is now falling faster than it has been. We finally got a red arrow. So when you look at a bearish Hakunashi candle, a red arrow, and falling PPO, that's a sign of an intermediate decline. We haven't had that since that Halloween low point. So we have that now on the S&P 500. We have it on the Dow Jones Industrial Average. We've been red for a while. Still down there, still falling PPO, still a negative Hakunashi candle. The Nasdaq 100 also got a red arrow this week, falling PPO, pretty negative Hakunashi candle, so the Nasdaq's on a decline, and then the Russell 2000 did not, actually got a positive, though we got a red arrow, but you can see very neutral candles. It's not really trending one way or the other. In fact, if you look at these Hakunashi candles, let me give you some perspective on these. How small they are. You can see we can't really get going with a big bullish or a bearish candle, one direction or the other, to really get a good trend, kind of break out to a new trend here. Let's take a look at some of these other oscillators. Excuse me. Here is the RSI and the CCI. You can see a little bit of divergences forming here with the lower closing lows, with a relatively higher low there, and obviously a much higher low on the CCI, coming out of bearish territory on both of these, though not really significantly moving to bullish territory yet. Very important to keep an eye on there. The Russell has broke up to above the midpoints of the chart, but again, has been in neutral territory for a long time, and it's not really breaking out of this neutral area yet either. In fact, if you look at its trend strength indicators, it's very noisy. It's even more noisy. We haven't been above 50 since that bullish run. It's been very, very noisy, sitting right in that cloud. SPY, however, has gone into bearish mode, bearish intermediate trend mode. We are below -2. We are above 65. So it's not very common. And again, when you get below -5 and above 80, then we are entrenched in a bearish trend, which we haven't had since the COVID low point. Come over here. There's the COVID low point. You can see when we got below 5 and above 80, it was right there on February the 27th on that drop, and that really solidified the weakness that we didn't have until then. Some of these others, you can see you kind of get to about that 2 level, a little bit past the 2 level, a little bit above the -2, maybe up to the -5 and 80 level, and then that kind of ends it. In the case of that intermediate low point over there, 2018, you can see, when we got above 80 -5, that kind of ended it there until we kind of broke down to a significant degree, and it got worse. Over here you can see too, you get to -5 and above 80, and that kind of ended the run at that point. So we're not quite to the -5 and 80 to the point where we might get, again, that kind of market sentiment type decline, where the orange line on the market sentiment drops. We are still in bearish breakout mode on SPY. We are not in bearish breakout mode on IWM. Very, very neutral mode on there. So very, very big distinction still between what we're seeing on the Qs, which has got the lowest positive indicator we've seen since all the way back over here in March, and the high, one of the highest negatives that we've seen. And again, remember the Nasdaq did form intermediate pullbacks here. The negative indicators got this high. Look at the ADX ramping up. So you never did get that high in May. It is now up to 28, getting to a higher level than it got, or about to the same level they got in March by the time all was said and done. Again, if I were to look for some perspective here, you can see you take out the COVID, which is kind of an abnormal intermediate decline, and look more at that September level, and you can see the ADX, we were coming off a really steep a parabolic high point. If you look at over here, really in 2018, very similar to this period where we didn't come off of a parabolic high. To early 2018 we did, and the ADX got all the way up to 40 before things again really hit the fan. So that appears to be the type of move that we're headed towards here, absent that big drop that we had, which again was very trade related, and at the end of 2018 it'd be more like the first probably 2 months of that Q4 of 2018 is the type of move that we're seeing here so far, right? Of course, when you look at like the 2-line version of this chart for SPY, you can see why we rallied as much as we did. I've told you before that you get your biggest up moves. You get your biggest up moves when you're below moving averages and when you're coming off of big down moves. And so it's not surprising that we got a 1+% move. We expected that it would come on Friday, and we got it. Because that's just how this works, right? When you extend away from the 8-day moving average, you come back up to it, and even potentially through it to the 17 before you extend back away to the downside. It's very the bearish runs are quick and deep, and then we rally, and then there's another bearish run quick and deep until we eventually get to wherever the low point ends up finishing. Which, again, 415 is a point of control. 400 is an area we've talked about before that would actually be below the 200-day moving average, but sitting right there at where this orange line. This would be more of an orange level. Looking at the market sentiment type decline coming off that market low point, so right around that 400 area is where you'd be looking, and that's how far below the 200-day moving average you would be. The Qs, of course, the 200-day moving average is sitting right at some very important levels here, right around 335, and IWM, breaking its 23% level would be well below. It's really like as much as bullish as it looked. Your moving averages are really converging. Even all of them are really, really converging right at the point of control. It's so crazy that we have converged this far for this long. It kind of looks like when we had this kind of bearish divergence right there by July 31st, 2020. You can see that all the lines were kind of sitting right on each other at that point. Just to kind of give you an idea of what the point of control looked like there. So 7/30 of 2020, going back to August the 1st of 2019, kind of very similar, where all you were converging, with all those moving averages right at the point of control there. Well, let's go back to that 2-year time frame. There's that convergence now, and then there's that convergence over there, and you can see we tried to really kind of get going to the upside before retesting the 200-day moving average, and then really taking off from there. But again, so we're going to get another type of move where we kind of really break out here and maybe retest a little bit before breaking. But you can see we are, you would be anticipating a pretty significant bearish move. Obviously SPY, we got some bearish levels here, but if you look at IWM and you look at its bandwidth on a weekly chart, you can see how low the bandwidth is, and just how much we've really been consolidating here. Let me take off that expiring cone. So you can see how much we've really been consolidating. You can see how very little volume there is below, and why it's very important we don't break that lower weekly that lower weekly Bollinger Band. When you look at the Keltner channels, see how the bands are way inside the Keltner channels. So and the bandwidth as low as it is, we are definitely setting up for a breakout type move. I mean, we were kind of to that point back there in July, but even more so, even more so now than we were then. Here, let me get rid of that expiring tone again. Way even more so now than then. And the IWM is setting up for a pretty significant breakout. The question is in which direction. Upside would be great, downside not so great. Let's take a look at the intraday chart for Friday. And you can see the nice little bullish rally, lower high, lower low, but we did close up near the point of control. So that'll be interesting to see on Monday whether we can maintain and break through and fill in some of that volume gap up to that resistance level. So not as bearish as it could have been on SPY. On IWM, we actually had an outside day. So we had a lower low first, but then a higher high, and then closed again at the point of control at the high point. So not as bullish either. So then, again, can we get through this volume that kind of stalled us on all these indexes, the point of control on all these indexes here? Again, not as bearish because we closed above yesterday's low, but also heavy, relatively heavy resistance above or at where we're at on these indexes on an intraday basis. If you take a look at the volume and the trading range here, again, you can see light pink shading across the board now. 3 red arrows across, except for, again, on IWM. We did get the green arrow on the stochastics. We do have clear. But we have light pink shading for multiple days. We only had it for the 1 day on the Russell, so that's a nice little bounce signal when you only have it for 1 day. But you can see we kind of did that over here too. So it's very important that we don't oscillate back down the red arrows, especially considering the stochastics is the one that gave you the green arrow, and this is barely green. If you take a look at Friday's volume, well above the average, 129 million. The trading range was also well above the average. Those are bearish numbers. As bullish as that day was, those are bearish numbers. Again, if we can follow that up with another good bullish strong day to the upside, then we're breaking through the 8-day, breaking through the 17-day, and we're going to feel a lot better about things. But as long as we're below the 8-day and we're getting days like this where we're getting strong ranges and volumes, it's very typical of bearish trends. Even though it was a bullish day, it's very typical of bearish trends to get such strong levels. Again, 8.8 and 129 million. To kind of give you an idea where that's at, 8.8 is off the charts. 129 million is off the chart too in terms of the averages. So these lines are really, really moving up higher. We're up to over 1% now. And again, if you're thinking, well, this is a pretty high number, 1.2%. Nope. 2%. But getting up to 2% is kind of the indications of when you might be done with these pullbacks. And we're only at 2%. Of the ATR would be getting the ATR at this level up to around, if we were to get to 400, it'd be getting the ATR up to about 8 points. And like I said, we had an 8.8. So if we get more days like that, we are going to get that ATR up to 8 points, and then that will signal, especially when you combine that with volatility getting up above 100% here, especially getting up above 100, maybe 105 up to 115% for a market sentiment type decline. So those are kind of the expectations, I think. I don't think we're done. I don't think this is the low. It's kind of hard to call, the bottom in when, again, you've had a 5% decline barely coming off this 38% rally. And again, when you look at it on a 10% level, so kind of more of a market sentiment type decline, we've gone 102% with, again, about, since we didn't get since we are off that 5% low point, now we're only currently down 4%. 5% is the max, and we still haven't gotten down 10%, which, again, you can see this is, a pretty decent amount of time here that we've gone without it. We've gone further before 2000. We've gone multiple years without 10% decline. 3 years? Probably about 3.5 years. We were pretty close there in some of these areas, but especially right in that low point there, and even in that low point. In fact, if you were to change that to about, let's see if it was 7% in 2012 there, it looks like, yeah, we had 9.94, so it's about as close to a 10% drop as you can get. And that was also a pretty, decent market sentiment decline, prompted QE3 there in late 2012 to kind of give you an idea of what that looked like. Let's go back to get some perspective. And then 2012 over here. So there's that almost 10% drop. You can see it brought the market sentiment line down below 40. And then there's that one too in the late 2012, which also brought the market sentiment barely below 40, but it also brought it below 40 down there, and got you multiple clusters, significant bearish. In fact, the intermediate line got below 10. The intermediate line got below 10 over there too before diverging with another cluster. So I mean, these are pretty significantly bearish moves, even market sentiment declines, even if we didn't get a 10% decline. So really, when you look at this zigzag here, and you look at that time frame without a 10% drop, and we had gone multiple years, you can't really consider 2012 being part of that, because I guess I have to go further out. You can't really consider 2012 being part of that, because we did get some markets, some significant declines there. And even there in 2014, that was a pretty sharp drop too. So really, it's coming off of what, a year, and a little bit would be about a month, and then over here would be about 11. So almost 2 years, a year and about 10, 11 months. Before you went from that low point in November 2012 to that low point in October of 2014. Again, to show you what that October, even though it wasn't a 10% drop by definition, October 2014, you can see right here that big drop, long lower shadow. That's why you didn't get the 10% closing drop, because you got those big long lower shadows right there. Your market sentiment line didn't quite get below. It came pretty close. It came out of bullish territory. You got the clusters, and your intermediate line got all the way down to the 5th percentile there, 5.74. So that's a pretty deep. Again, it was only not a 10% drop, or considered more of a drop, because we came off of the low. If you look at where we closed here to the low point, that was a 9.5% drop, and obviously would have been a lot more bearish at that point. So kind of gives you an idea that, okay, well, here we are well over a year and a half now off of that market sentiment low point, and how far down can we drop? 4,000 now is not out of the realm of possibility at all, considering that length of time, and that would be about a 10% decline from those highs. I think about up to 12%, I think, is what it gets to off that 45% high. And coming off a 100% gain, that's not unfeasible at all. It seems very, very likely and very, very reasonable. And as you've seen on that zigzag chart, would lead to a new higher high point at some point with a pretty decent number inside whatever green box it formed at that point. So what do you think? Do you agree with that? Do you disagree? If you disagree, let me know in the comment section below. Why you're either a lot more bullish or a lot more bearish than I am. What charts or indicators you're looking at that would suggest why you're either bullish or bearish. Share with us down there in the comment section below. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. You liked our video today, and you want us to do another video again on Monday. Quick way to give us feedback if you like our stuff. If you don't like our stuff, of course, you don't have to click on anything. You don't even have to watch it. Also, comment down there. What did you get out of our videos today? What stood out to you? Why should other people check it out? Post that in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle there at DavidSettle42, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, click over here on the Market Outlook Live icon. That takes you to this page. You can see our Market Outlook Live videos. This is where I look at all the existing Market Outlook trades I've done in prior videos, see whether or not we should stay in them, get out of them. We talk about how to manage it and when to exit. We also put on today's trade idea before the market closed, so make sure that you check that out there. Also, you can come down here, see our upcoming trading rooms. If you click on view more right there, or come up to the top and click on trading rooms, that takes you to our calendar where you can see all of our upcoming classes, as well as all the recorded classes that go back 3 years, all the way back to 2018 when we started. Come down here to the bottom, click on that heart icon. It opens up another new tab. Click on that like button there. Click on this thumbs up icon, opens up this new tab. Hit that like button as well. Again, the more you do that, it helps us get our content out to all of our followers that follow us on these platforms based on how their algorithms work. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. All right, let's take a look at how things ended the week in terms of what drove the price action here. So let's go down to Friday's action alone. So let's give us 1 second to pull this up. You can see very big rally in small cap stocks, real estate, commodities, all outpacing the S&P 500, all up 1% or more. But interestingly enough, bond prices rallied too, and bond prices and tech stocks ended up with the same returns, which is not very common. Of course, it was on a day where the dollar dropped as much as it did. That didn't really help out emerging market stocks too much as they continue to lag. Developed markets and international stocks as a whole lagging behind U.S. stocks pretty significantly for the day. If I were to go all the way back to the beginning of the week here, so let's go to about, so we can kind of see how the week ended. Interestingly enough, the dollar finished higher on the week, despite that little weakness on Friday. And gold also finished higher too. So, and commodities really took off throughout the week. So that's not the most common combination to see the dollar and gold both outpacing both bonds, equities, real estate, other fixed income products at the bottom there. So really on the commodities rallying, and again with the strength in the dollar, it's kind of interesting to see that. It's very inflation with weak bonds and strong commodities. Even with the strong dollar, it's very inflationary from an inflationary standpoint. Let's take a look at that dollar. That dollar really had a breakdown on Thursday, big time breakdown over here. Actually, excuse me, it was on Wednesday. And then holding right around that 50% retracement level there of this long-term move. If I were to zoom out a little bit, you can see, let's go up to a 5-year chart. You can kind of see where that 50% line is coming in. It's the 50% of this big bullish move that the euro had against the dollar from the COVID low, essentially, which is a couple months later in May, all the way up to January of this year, when the euro peaked and the dollar bottomed. Dollar's been rallying ever since, but it's kind of sitting at that 50% level. I still think that you've got potential coming down to about 1375, down to this big long-term trend line that we had broken through with the COVID move for the first time in more than a decade. So I mean, it's a very significant resistance trend line down there. We are obviously well below the moving average. I expect it will kind of come up towards the moving averages here in the next little bit, when there is a little bit of a bounce back at points in risk appetite. But you can see we are well below the 8 and the 17-day moving averages. They are well below the 30, and the 30 continues to trade below the 50. Try to get up towards the 50 there, but it's still well below still below the 50, and all these lines are still well below the 200. So we are in still a very easily a death cross environment for the euro, or would be a golden cross environment for the dollar, and that hasn't changed yet. And I don't expect that will change until this bout of risk aversion is over with. Long-term bonds, on the other hand, you can see had broken down again. again, from a risk appetite standpoint, you would expect bonds to go up, and we are still in a golden cross environment for long-term bonds. But in the last week or so, we had pulled back down, kind of a big jump in yields, pulled us down below the 200-day moving averages. We finished the week back above the 200-day moving average. Now it's a question of how long it takes to get back up towards the 50 and back up towards at least the 8 and the 17, and what we do at that point. That is long-term bonds. Gold, you can see, had broken way down, extended away from its 8-day, and as it usually does, pulled right back up to the 8, and now it's at the 17. And you can see the point of control sitting right at the 30 and 50-day moving averages, as gold is in a death cross environment. Again, that's compared to the dollar. Remember how strong the dollar has been. Gold compared to stocks has also been relatively weak too, and that's the important consideration in terms of risk appetite. So that's kind of what we're seeing right now. If you take a look at the major markets that are out there, let's see here. Let's go to the global 12 grid chart, and you can see lots of dark pink shading and a red line. Again, when you look at the major currencies relative to the dollar, everything has been down against the dollar over the past 3 months. And when you look at it just over the past week, so let's go back to September. Just look at how things performed over the past week. You can see everything was down against the dollar. A little bit of a rally in some of these, like the Canadian dollar, the Australian dollar, the pound and the franc. The yen and the franc also rallying. The euro really down, and then the pound also down. The pound rallying off of lows, but the pound was also down about the same as the euro by the time the week was over. Remember, the dollar's been on a little bit of a run for the past few weeks. So if I were to kind of shoot this out, you can see how weak the euro and the pound have been. New Zealand dollar have all been. Only really Canadian dollar has been strong against the U.S. dollar over this time frame. The franc and the yen, other safe haven areas, have been also outperforming currencies like the euro and the pound and some of these commodity currencies here. So a little bit of a risk aversion trade that's really driving a lot of the strength in the dollar. And when you look at it from a sector standpoint, we look at the sector 12 grid here, you can see dark pink shading and red lines across the board. Right? Only really energy, which is going crazy and kind of keeping IWM afloat to a degree. Financials and energy both. Everything else very dark. Even the safe haven areas are pretty much the worst out of all of these. In fact, when you look at XLU versus XLE, so kind of a reflection of safety, right? When you have the energy on one hand and utilities on the other, which have been so bearish, you can see, just how extreme its MACD has gotten here, how far below its 8-day moving average. But I do want to switch this back to more of a longer term view of its long-term PPO and just see how bearish it's been. But coming off of here, just for some perspective on where that low point is, again, for utilities relative to energy. Utilities have been very bearish here relative to energy since the COVID low point. You can see it was very bullish during this bear market that we had been in since early 2018 all the way up to the COVID low point, where it exacerbated that. And you can see some other periods of time where utilities was more bearish than energy during a really bullish run on the dollar. That's not necessarily the case right now, and you can see the drop back that we've had in this. These are the 8 and 17-day moving averages. So very, very strong momentum on the MACD chart. In fact, if you were to look at that, just to kind of give you an idea on a long-term basis how bearish that MACD is, let me switch the PPO to have the same time frame. So this is the PPO, kind of gives you, see, it's a little different because the MACD is based off the numbers over here on the right. The PPO is not. So just to kind of give you an idea, we've had, this 2.5% mark's about as low as the PPO usually gets. So the 8 and 17, this is a very, very strong momentum. It's very similar to some of these levels that we've had coming off of a relatively high momentum. So I expect that we'll be running out of some bearish momentum here pretty soon. and forming a low point, especially considering your ADX or your CCI has been extremely low. Your ADX has been extremes in terms of its where it's at. Here, let me zoom back in on this so you can kind of see the ADX down here. The negative indicator all the way up into the 50s. We've seen that before over here. That kind of sets the low point, right? And the highs down here just a little bit below 20. The positive indicator, in green, you can also see a period over there. So it appears to set that low point when you're looking at that MACD. Here, let's change this to like to the 5200 again. There we go. So that longer term view there kind of sets that MACD on some of these other lines when you get that extreme. And of course the CCI has been below 30, and that's again very, very significant low point. So it's pretty darn extreme in this area. And again, when utilities outperform energy, it's not necessarily a sign of risk appetite. So it's interesting that we've been so bearish here during the month of September when the market itself hasn't necessarily been bullish either. Whereas the market has been really bullish in some of these other periods, it hasn't been bullish during this time frame. So it makes you wonder just how much of a risk appetite sign, or how much we haven't had the risk aversion trade yet, because utilities and energy, like this relationship, hasn't played out as you would expect. Another relationship of risk aversion versus risk aversion versus risk appetite would be staples relative to discretionary stocks, and you can see that they've been bearish too during the month of September. And again, not what you expect during a bearish month in equities to have staples underperforming discretionary stocks. Typically, you would see the other direction. You would see it doing much better than technology stocks. So, as bearish as we've been, it doesn't seem like we've been that bearish yet. In terms of these safety trades, really outperforming and rotating into favor. In fact, when you look at the rotation graph here, let's go to a sector rotation, and we'll go to a daily chart on this. In the leading areas, you have financials and energy, discretionary to a degree, and you have your safety trades, utilities. That doesn't look like we've been in a pullback. Real estate doesn't look like we've been in a pullback. Staples kind of looks like it might be moving in that direction, and healthcare. Neither one of these. I mean, if we were in pullback mode, again, going back to the last time we've been in a real significant pullback was back in September right here, and you can see utilities and real estate and staples. Real estate, utilities, to a degree, healthcare. These are your safe haven areas, and you can see how they outperformed during that period of weakness. They outperformed there. In fact, here, let me just go utilities here. You can see how they were underperforming going into the peak, and then during the pullback, they really outperformed and stayed bullish until we started to bounce up. Then they started to outperform again. Very, very, very typical. You can see over here too, they lagged until the peak, and then they really outperformed. Very typical, right? There's your safety trades, staples, healthcare, utilities, real estate. That's where you would expect them to be, and that's not where you see them right now. Right? That's not where you see them here. We are definitely not in. Here, go back over here. We are definitely not in in an area where they're up to the right, right? They're still, in fact, best case scenarios, a couple of them are kind of languishing in the blue, and the other two are in the red, just barely turning up from going down to the left. So again, not the environment where it's like, whoa, we've really been selling off here, and the low point should be set in here at any point in time. In fact, another thing we look at I've looked at here, is the skew. And in the past, the skew, when we've set these low points, the skew usually drops below 120 when we've hit these levels. If I were to go back out a few years to see these intermediate pullbacks like we had in September, of last year, right here, this actual intermediate pullback, we dropped all the way below 120 on the skew. Back in the fourth quarter 2018, we dropped below 120. Back here in the first quarter 2018, we dropped below 120. And a few times in 17, we didn't really get significant declines. And then you can see all these other pullbacks that we've had. The skew gets really low. Well, the skew right now is just barely at 135. It's hardly dropped to a point where, we've had, even the 4-week average is still up at 146, or 20-day average is still up at 146 for the skew. That's still higher than the peak we had going into the fourth quarter 2018. That's a very, it's off of the highs, but it's still a very significant high at current levels. So we've hardly had the sell-off and out of the money puts that would really, that would really dictate that, we're really not that, we've sold off. We've had the move that's kind of blown off all this excess and risk appetite. When you look at the gamma exposure here, you can see again that how low it's been and how low it currently is. So you can see that the people are not buying call options. They didn't buy. There's even with the bounce up, it's still a really low level on this bounce. So it's hardly, we're hardly seeing a big demand for call option trading for these areas. And you can see these low points again. We're not seeing the big demand either for the inside, the dark pool buying, which would be at these high levels. As you can see, when you get to these really low levels here, even some of these low levels during September, when we got up to right around 44% in this area, 43%, and right now we are sitting at 43.7. So we're not quite up to some of these highs, or even some of these highs that we saw back in December of last year, going into the new year when we were pretty darn bullish. There's not that much demand yet for risk appetite behind the scenes. All right, that brings us to our market outlook trade idea of the day, and I wanted to take a look at Etsy. If you see Etsy had been pretty strongly bullish, ended with a cluster, now is not, right? The intermediate line has fallen out of bullish territory. Short-term sentiment has fueled that decline, is now seems like it's bottomed out. It's trying to neutralize, kind of stabilize the selling here at this Fibonacci retracement zone, the 23% retracement level that we've seen before. If you were to redraw these retracement lines on the current intermediate run that we've been on off of this oversold cluster here up to the peak, you can see it would be the 38% retracement of this current run that we've been on. A little bit of a dip here in the middle, down to the about the 78% retrace, a little bit below the 62% retracement at that point, but you can see now where the support level is and why we kind of held so far at that point. If you were also looking at the Bollinger Bands for Etsy, there's some volume support in this area as well, right around the retracement level. If you take a look at the 3 green arrow chart, whoops, not that one, the other 3 green arrow chart, this one, you can see the 200-day moving average is also sitting right here. We're in between the 50 and the 200-day moving average. The 8 and the 17 just kind of barely crossing. Lots of volume in this area. If you look at the Bollinger bandwidth, we are pushing against the lower end of the bandwidth. And you can see bandwidth is rising, but you can also see the bandwidth is sitting right in between the 0 and 38% retracement. So there's an opportunity for us to kind of trade inside of that area. So what I decided to do is to sell a put spread at the bottom and sell a call spread at the top, 240, 250 on the top, and a $5 wide spread on the bottom, but just double the contracts. So what that ends up looking like here, let me delete simulated trades and bring up, I see, oh, I got it beta weighted. There we go. Bring up the trade, and let's go out to November expiration, which is what we did it for. Doing the 2 contracts on the bottom, the 1 contract on the top, so that gives me about 2/3 of a normal position size, but for a return that's about what I get for a normal position size. So that's because we have earnings coming out. So when you look at those slices that we put to break even and put those on the chart, then you can see my break evens. I mean, my bottom one's way down here where that point of control is. And we'd have to break below both these Fibonacci retracement zones to get to it. Then my top is way up here through the 0% level up to a higher high. It'd be the 52-week high. So got a very wide range, very good, lots of volume in the middle of this range that we can trade around and be able to get our maximum gain on this trade. All right, well, that does it for me. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below. Have a great rest of your weekend, everybody, and we'll see you all on Monday.